banks are the culprit this afternoon, because if you look at the markets, they are trading at the low point of the day because of the Nifty Bank. So 172 points off for the Nifty, 24173, 570 points on the Sensex, and this is despite the bias looking like it was going to be on the upside. And if you just look at the points contribution list on the Nifty per se, you will see that HDFC Bank arguably is one reason. So if you strip off this 87 points off as well on the Nifty from HDFC Bank's perspective, and even if it go to zero, we've still been in the red, by the way. But the point being, HDFC Bank is the lion's share of the points contribution, and frankly the heat map will show you just that it's effectively an HDFC Bank MSCI change led fall. The good part about this, that this may not necessarily be the case tomorrow. And we'll ask our technical experts about it a bit later on in the show. But it seems that some of the pain, at least in that boy, will be contained. But some of the others like Shriram Finance, Tata Motors, etc. have all come off. And the screen is looking a mirror image of what it was looking like in the session at the start of the trading day, because the quantum of green has gone down quite considerably. Alarm bells? Maybe not. Maybe a bit of geopolitical Middle Eastern stress coming into other markets as well. But I suspect such things can literally be par for the course. So bear that in mind. Broader markets, Hersh, how are they doing?
Well, there's a bit of pain, Niraj, where broader markets are concerned. Let's pull up the Nifty mid-cap as well as small-cap indices. And let's look at a few specific names as well. There you go. The Nifty mid-cap is down around 0.6 odd percent. The Nifty small-cap too, trading roughly 0.8% lower. So the pain much more where it comes to the Nifty 50, which is different from where we started the day off for sure. So that's probably a couple of differences that have played out through the day. Let's pull out a couple of names newly listed, because there have been two blockbuster listings. So we'll talk about the positives first. Unicommerce up 93% from list price, and we have Brainbees, which is First Cry, which is up 47% on today, which is on the day of listing. Of course, this is from the issue price itself. So doing extremely well, those two. Let's talk about a few more names. Aarti Industries, on the back of muted, or if I may call it, withdrawing some of their positive commentary which they had given earlier, now signaling some uncertainty, 15% down the stock, really taking a beating in trade today. Outside of that, in terms of losers, let's pull up something like an Alembic Pharma, despite an approval coming through 3.5% lower. Indus Towers down 2.5 odd percent, mind you, buyback happening over there. And Man Industries as well, around 1% or so down thereabouts. So some other newsmakers, or rather on the back of news, some other movers. Let's pull out some on the back of results. Electra Green, 8.5% higher, very strong reaction to those numbers. We have Senco Gold, again, very strong numbers, good commentary, 6.5% higher, that one. Hindustan Copper up 2.5%, and Ingersoll Rand also up roughly 2 odd percent. DOMS Industries, on the other hand, down 6.5+%. Dollar Industries, mixed bag in terms of results, but largely looked in line, but being beaten in trade today, almost 5.5% lower. Ami Organics is the other one, 2.5+%. Happiest Minds also down 2.5%. We spoke with management as well of Happiest Minds. And we are going to speak to the management of Hudco as well. Let's quickly pull up that stock, 1% or so lower. Let's pull up the Sugar Pack. Those stocks in focus on the back of positive policy on ethanol blending. So pretty much all sugar stocks in focus. Let's pull them up, and there you go. Some positive reactions. Ugar Sugar as well up in trade, and maybe outside of maybe one or two names, pretty much all names are buzzing in trade. So that's the sugar stocks in focus. A couple of names on the back of brokerages. Signature Global up 2.5%, initiating coverage note from Motilal. Very strong upside given by Motilal, nearly 40% from here. So keep your eye out on that one as well. Plenty of stocks to talk about. Let's also pull up some wind power stocks, Inox Group, as well as Suzlon. So all of those in focus, Niraj.
Yeah, most certainly. But, MK Conference in Focus, we are exclusively covering it yesterday and today. And on the back of that, Sheshadri Sen, Head of Research and Strategies at MK Global Johnson right now from the venue of the conference. Sheshadri, great having you. Thanks for joining in. You know, this is Niraj here. I was reading your note yesterday wherein you mentioned that at the end of day one, the corporate commentary was sounding very constructive. I would love to understand if that is the cumulative view at the end or near end of the first 2 days of the conference.
Yes, pretty much. I think the most important takeaway from the corporate commentary is that most Indian corporates, especially and as we go down the market cap curve, that becomes a little stronger, surprisingly, are in a very strong growth mindset. There doesn't seem to be, any flinching. There's been some setbacks in the last, say, 2 or 3 months. But nobody's, I don't see any confidence getting dented. The medium-term view, 2 to 3 year view across most sectors is that the growth outlook looks very strong. Nobody's pulling back from their Capex. Yeah, of course, near term, there will be some volatility, maybe a little bit of pricing pressure in a few sectors. But, the longer term, especially in the B2B space, we are seeing that the confidence of the management continues to be very strong. And that is the basis for this bull market, that this is the B2B space, the entire manufacturing space has seen a major turnaround post-COVID, both in terms of earnings and growth outlook. Sure, some of those areas are valuations are a little stretched, but there's no arguing that the long-term growth outlook for these sectors remain very strong.
Mm-hmm. Okay. Sheshadri, what stood out, because I know we were there at day one, right? And our team is, of course, there for today as well. But because I was there yesterday, energy was the cornerstone. Somehow energy, recycling theme and some others came in conversation with participants out there. So what from the corporate commentary thus far that you may have heard or gotten feedback from your analysts or from your clients, from which themes has the commentary been the most constructive?
There have been positive commentary across a lot of spaces. Green energy, certainly. Green energy is one area, the entire green space is something that we all know. We all know that, India, long term has to decarbonize. That is opening up opportunities in many sectors, from green energy to recycling to allied sectors, and the confidence that the corporates have in that sector, that this is something that I think we've crossed the hurdle where there were question marks maybe 5 years ago. Is green energy sustainable? Bad choice of word. Green energy, is it profitable? But I think those issues have been sorted out, and the dependence on government subsidies is reducing. And certainly that area, you're right, is one area where we are hearing a lot of positive commentary. The other is the overall industrial space, the entire capital goods and that entire sort of universe. Sure, some of the valuations there are a little stretched. But there's absolutely no worries about growth there. The order books are looking very strong. The execution is proceeding fairly well. And the big factor there is that the long-term order books are looking very good. Even the most conservative managements are investing in fresh capacity because they see visibility on growth. And as we all know, in the post-COVID world, balance sheets are very strong. These companies, though they are investing in growth, are doing it through a judicious mix of their own internal cash flows, equity and debt. So despite all that growth, we are not seeing balance sheets getting stretched, which has happened typically, especially in the cyclical sectors in the past. So these are the two areas, green energy and capital goods, where we are seeing a lot of confidence come through from the managements.
Sure. Mr. Sen, this is Hersh also joining in. Just wanted to quickly have your take. You've spoken about plenty of positives, but anything on the Capex cycle? Because we've waited long enough with regard to when the Capex cycle will start? Any indication of managements or any conversation around this which gives you better feelers of a possible Capex cycle on the annual?
Let me answer that in a slightly nuanced manner. Companies with respect to their own historical Capex are stepping it up. So we are going to see corporate Capex picking up speed over time. If you look at it from a macro perspective, that number, however, is not a very large number. The entire Capex cycle for the country and for the economy as a whole will continue to have to be driven by the government, where again, as we saw in the recent budget, they've not taken a step back, right? The government Capex program also continues to be fairly strong. If you look at the macro numbers, corporate Capex will always form a relatively smaller portion of the overall Capex. Now we are lucky that both engines are firing, both corporate Capex and government Capex are doing very well. But for the longer term, we think that government Capex has to sustain, and we are quite confident that it will.
Sure. And Mr. Sen, a large number of participants, especially the companies coming to the forum, have been within the SMID segment. A lot of research analysts on the street seem to believe that an earnings catch-up is necessary, especially in that space. Are you also of that view, and do you believe that is expected to happen? Is that a reasonable certainty?
The SMID space is very big. It is very difficult to generalize like that. Certain pockets of the SMID space, I agree, the valuations have run ahead of themselves, earnings will catch up, and the stocks could do a time correction for some time. And SMID stocks tend to be volatile, so time corrections could quickly turn into price corrections as well. But that's a part of the SMID space. There are, it's such a vast space that there are always opportunities. Even with sectors which from the top look overvalued, if you dig deep down, you'll always find reasonably valued companies at an inflection point on growth or at an inflection point on cash flows, where we will see some turnaround coming. So I would say that it is as a generalized comment, it may be accurate. But then, if you go dig a little deeper, we think that SMIDs, you will always throw up opportunities. The broader story that we think that over a 2-3 year time frame, SMIDs will continue to outperform large caps as they have done in the post-COVID bull market. That trend is not about to change. We think that SMIDs are the driver of the market for the next 2 or 3 years, primarily because the earnings is getting democratized and valuation is, there are better pockets of value available in the SMID space.
Got it. Thank you so much, Mr. Sen, for speaking with us, for taking our time and for giving us that quick take on everything that's been happening from the MK conference from St. Regis in Mumbai. Thank you. Anyway, with that, we'll slip into a very short break. On the other side, we have the management of Hudco lined up. The stock obviously doing well in trade, but at least at the start, we opened up well. Currently down around 1% or thereabouts, but very strong numbers. So stay tuned for that conversation. welcome back. Thanks for staying with us on India Market Close. We have with us Mr. Sanjay Kulshrestha, who is the Chairman and Managing Director at Hudco, to talk to us about numbers. Very strong growth coming in from Hudco, YOY 30% on the loan book, 19% on total income. Mr. Kulshrestha, can you tell us whether a 25% plus loan growth in FY25 can be expected now with the kind of Q1 performance you've delivered?
Very well. I think the 25% of the CAGR growth will be within our limits. And since the company is extending loans towards the infrastructure, entire gamut of the infrastructure, which includes the affordable housings also, other than the road, water or power or energy or whatever there in the infrastructure list of the Government of India. So we have seen the leverage from the housing for all in the PMAY 1.0, and the similar leverage will be there, and there are tailwinds that the states will be coming out with the counterpart requirement under the PMAY Grameen as well as PMAY Urban. So it will give a very, very, very large potential for companies like Hudco, and since we are under the ambit of our ministry, that is MOA, so all these schemes will give that kind of impetus, and I think in another 2 to 3 years, our growth rate will remain higher between 20 to 25%. And this year, we are expecting that it will be slightly higher than the 25%.
Got it. That's bullish, sir. I want to try and also understand, where do margins go from here? You've seen some bit of margin pressure start to come in all the way to Q1. Is this now a sort of bottom you've made where margins are concerned? Does it only get better from here is what I want to understand.
You are right, actually. We are at the bottom, and it is because of the market pressures and the internationally domestic interest rates, which are governing our cost of funds. But we had tried and experimented a lot of things and a lot of measures, and you can see that we have per se. But at the same time, the commitment of the company, which is in 75% owned by the Government of India, will remain that we are here for infrastructure which is viable, which is more sustainable. And we are very well aware that the interest cost in any infrastructure puts value to that infrastructure. So that's why at the same time, we also know that a desired spread and the NIMs are also required for the company. So we are working between 3.3 to 3.5% of the NIM, that is net interest margin. And if you can see our presentation also, wherein we had very clearly shown that out of total borrowing, around 20,000 crores is against the EBR, which is giving us the service charges. If we reduce that EBR, our NIM is around 3.7% and spread is around 1.7 to 1.8%. And I am very clear that we will be maintaining these kind of NIMs between 3.5% around and the spread of around 1.7 to 1.8%.
Understood. And what's the recovery pipeline like? You've got plenty of recoveries in the pipeline, clearly. 1,400 crore within the NCLT fold itself. How much of that materializes, say, in FY25, and how much are you penciling for FY26 and beyond, if at all?
I think by FY26, all the assets should be resolved. But at the same time, we know the process of the NCLT, so we are completely dependable on the process, and we are pushing and pursuing very hard with our consortium partners so that the resolutions should come. And we had seen during last year, lot of updates are there in the NCLT, and lot of assets are going to resolve. And during this quarter, during this financial year, we are trying that out of 1,400 crores, at least 500 crores of the loans will be resolved by March 2025. At the same time, we had revised our OTS guidelines and the way we were working, and we are looking at the assets that we want to resolve it, whether it is NCLT, DRT or DRAT, or through the lender-backed resolution plans as well. So we had opened up our policy in terms of the OTS. At the same time, we are opening up that we can also bid in case there are no bidders which are coming. And the total objective of the company is to come down to this stress assets towards the zero by FY26. Okay,
and sir, therefore, what does that do to credit costs? First, and I'll break this up. First, I want to try and understand what this does to your overall credit cost for FY25 and 26. Will you continue to be in negative territory where that is concerned, especially on your P&L? And I want to try and push that further. On your fresh lending that you've done, 30% odd growth, what's the kind of credit cost that one should pencil in if one were an investor?
Regarding credit cost, yes, our yields are improving, and at the same time, the lending is becoming very, very competitive because we generally works with a very, very robust kind of infrastructure and very robust kind of entities. Most of our loans or credits are extended to the state government and state government entities. They are backed by the state government guarantee and the budgetary allocations also, since these assets are towards the social sector. So this puts a pressure on the credit cost, and but it's okay. Finally, we have to maintain our yield slightly more than 9, and at the same time, the cost of funds should be as good as around 7. In last quarter, in FY24, we had been very well able to take out our cost of fund from 7.46 to 7.1%. Last quarter, it was slightly higher, but I am sure with the infusion of the ECBs that we are taking 400 million during this quarter, we will very well be within 7.1 or 7.15, not more than that. So it will give some space to our spreads, and at the same time, our yields will be higher.
Right. So what I'm trying to understand is whether you can maintain that 2.2% plus kind of ROA even in a normalized credit cost environment. Just want to try and get that. Are you comfortable, confident that the 2.2% is something like a normalized ROA, and therefore your PAT will grow largely at the rate at which your AUM is growing?
Yeah, I think it will not be a challenge for the company. 2.22 in this high cost regime we had maintained. So I think there is a good positioning regarding this 2.2 number. Maybe slightly it will go up towards the 2.25 when the rates start melting down. So when the AUM will start growing, at the same time we are seeing that we will introduce a lot of products. So starting from the state government guarantee to the project-based funding, wherein during the commissioning stage the interest rates will be slightly higher, and when the projects are established, we will give the discounting to them. So in a way, we are keeping our product mix so that it will raise towards the spreads, and at the same time it will give good value to our bottom lines.
So I just wanted to try and round this up. What gives you the confidence that in this benign credit cost cycle environment, of course, probably that's a one-off, and what gives you the confidence that that will continue, or at least for Hudco?
I think the confidence is coming from our promoter, that is Government of India.
Okay.
The way the policies are being framed, very, very transparent, and the way government is not only intervening towards the policy, but also the capital adequacy, capital infusions towards the infrastructure projects. So everything is planned towards the Viksit Bharat. A lot of infrastructure are planned, and all the states are on board. You can see the states are competing within the states, so that it is giving a competition between the states. Every state is aspiring to become a developed kind of states. Like we had signed an MOU in Rajasthan, and they are talking about Viksit Rajasthan. Then on the same lines, Maharashtra is talking about how the development can be done and how the multimodal corridors and the road connectivities, hospitals, and all these things are giving that kind of confidence to us that all these states we had sanctioned now start sanctions in the Gujarat also, if you have seen. So now Hudco has a footprint in entire country. So all these things are giving confidence. One, coming from the Government of India. Second, the plans of the state government. And third, the financial ratios, which we are very strong at the financial ratios. Our loan book is just 1 lakh crore. So there is a lot of appetite in the Hudco to grow. And there is good support from our ministry also, which is taking care of most of the infrastructure, starting from the metro to Swachh Bharat to Amrit City to Smart Cities, and now it is Housing for All 2.0, which will give a lot of potentials to the company.
Sure. Sure. Thank you so much, sir. It's been a pleasure speaking with you, breaking down the numbers of Hudco. Of course, very strong numbers overall. But in line with how markets are doing today, the stock is down roughly 2% odd. But time for a quick break. On the other side, we get you top buy today, sell tomorrow ideas, as well as insights into the MSCI August review, which is moving quite a few stocks today. So stay tuned for that.
Right, back with India market close right here on NDTV Profit. We are trading at the day's lows. That's the unfortunate part, that we are now 0.9% lower. And mind you, it's Nifty Bank. Actually, all indices in the red, but Nifty Bank leading the way. I think if you strip out Nifty Health, most other indices are looking wobbly. As I said, but the HDFC Bank is the one leading the way out there on your screen, the sectoral indices, and it's looking very, very wobbly. But an important thing happened overnight, which is the MSCI review and some changes out there leading to HDFC Bank doing what it is doing, some other stocks getting added, the embargo on the Adani Group ratings, Adani Group stocks also lifted. So much that happened. Sanjeev Hota, VP and Head of Research at Sharekhan by BNP Paribas Johnson right now for a quick perspective thereof. Sanjeev, good having you. Thanks for joining in. What did you make of this MSCI review? Some interesting choices of stocks, and more than the stocks added or deleted, the things around some of the specific pockets have gotten larger reactions.
Yeah, good afternoon, Niraj. The surprise was on the negative side as far as the HDFC Bank goes. The market was expecting that at one go, the MSCI is going to give a weighted change for the HDFC. That didn't happen, and it's going to happen in the two tranches. So that is a negative surprise for the market, and that is reflecting in the stock prices as well. Apart from that, I think On the other stock, I believe that is going to continue the way the mid cap is behaving, and some of the small caps are now going into the mid caps. So it is going to continue. We might see some more names getting included in the MSCI regime in the upcoming months as well. But that's the worry part, because I don't really see that fundamentally you cannot justify some of the names that has been included, because the fundamental is the valuation is still much ahead of the fundamentals. So that is worrying part for me, because it's keep on happening that the small cap is rallying and more stock getting added in the MSCI mid cap and small cap. That's the worrying part. It should not continue like this.
Sanjeev, which are these names which you feel do not deserve to be added, or the valuations are a stretch?
So really, I don't want to comment on the name, because I do not have the official comment.
Okay. Fair call. Understandable. Okay. So two-part question then, Sanjeev, and I'm sure Hersh would want to come in on HDFC Bank. So I'll come on the other piece, which is this decision to lift the embargo on review of the Adani Group stocks. I mean, and you know, the classic point when we were talking about it in the morning was that post the Adani Energy QIP, I'm using that as an example to just explain my point, Sanjeev, of course, that, you know, with the post QIP, in the normal parlance, that weightage would have gone up, but because there was an embargo or there was a freeze, there was no change there. How material is this? Because from a freeze being put post Hindenburg to this freeze being lifted just a day after yet another Hindenburg note, how material is that?
Definitely, MSCI must have decided this thing to be done.
Coincidentally.
They have not waited for another Hindenburg report to come. So I don't really see this is a correlation between the Hindenburg second report and what MSCI has done. But what I read is that it is a very welcome kind of move, because you cannot depend on any foreign agency writing a report on something, and MSCI is taking a stand on that. So I don't really see that playing out well. And I see this thing as very welcome move for the Adani Group's stock. And directionally, at least, I think it is going to be supportive for the stock performance. How and when, how it's going to impact, and how much it's going to impact, I don't know. But directionally, it's a very welcome move for the companies.
Sure. Sanjeev, this is Hersh also joining in. I want to try and get your take. Your sense with regard to how much of the flows have been impacted in HDFC Bank by this possibly deferred inclusion or added weightage, if I can put it.
It's half of what has been currently given, 1.8 billion kind of flow. I was expecting somewhere close to 3.84 billion kind of flows to coming in if they have done this in one tranche. So now they are doing in two tranches. So maybe it's half of what we are seeing currently, and more than half it's going to come maybe in the November. So that is the negative, I think, read through for the stock. But how I'm reading is that maybe going forward into November, the street may be anticipating this event to play out. So at least till then, it will be a supportive factor for the stock price. But the way the MSCI has done this in two tranches, it's not a very like a positive move for the HDFC Bank.
And do you expect HDFC Bank to have that required foreign headroom of now 20%, is what MSCI seems to be guiding? But do you expect them to meet that threshold likely in November?
Very much. I don't really see any reason. Because if you see HDFC Bank on a fundamental basis, if you read the annual report and the commentary from the management, in this interim transition period, the management is quite likely to go for a moderate kind of credit growth. They're likely to manage their balance sheet. They're likely to manage their credit to deposit ratio. So we are going to see a very moderate kind of earning performance from HDFC Bank. So to that part, I don't really see any major outperformance happening in the HDFC Bank. So I think there will be ample room for the FI or to be buy into the HDFC Bank. I don't really see that is going to create any major problem in the upcoming region of MSCI.
Okay, one final question, Sanjeev. You mentioned about this being a positive for any. I mean, are there past instances of any such things resulting in significant inflows because of a freeze having been lifted, or otherwise if in case it comes to your memory, because one is trying to say lifting of a freeze is one thing, whether it actually results into flows or no is separate. So are there past instances of a freeze of this nature having been lifted, then resulting in flows because the weightage uptick or downtick was not happening purely because of the embargo?
But it's not coming to top of my mind now. But I think if the free float is going to increase because of some corporate action coming in, now as you mentioned in the this total energy and Adani energy stock, so there might be possibility of a major weightage change happening in the Adani group stock. So it depends on the corporate action going forward.
Just wanted to round that off. Sorry, Hersh. Yes.
Yeah, Sanjeev, sorry. Would you therefore go in and buy HDFC Bank today? 3.5% lower.
So if you go by the preference or the choice, I believe HDFC come fourth for us. First is in the line of ICICI Bank, followed by Axis, IndusInd, then comes HDFC Bank for us. So it is not the first choice for us to go for a overweight kind of position in the portfolio.
Sure. Point noted. Thank you so much, Sanjeev, for that, for bringing us those views. Anyway, so we'll let you go on that note, Sanjeev. Thank you. Let me also bring on board Kush Bora from kushbora.com, as well as Nirav Ashar from Latin Manharlal. And Kush, let me come to you first. We've just spoken about HDFC Bank, the key drag on the index today. Now, of course, we've had most stocks following, following that slightly negative start that we had today. Thanks to HDFC Bank, we've seen most stocks follow that. What's your sense on this one, on this specific counter, as well as on the larger market, on the Nifty as well?
Hey, hi Hersh. First of all, very good afternoon. Well, to start with HDFC Bank, the stock's actually now very close to that, rather the support zone of 1580, 1590. I'd give it one more day. If that level is held, perhaps might just turn out to be a buying opportunity. Again, it's not a big mover, so it's not a trader counter per se. But from a positional standpoint, I think this would make the risk-reward ratio fairly attractive. So don't go out and buy it today since we're closing at the low point of the day. But give it another day. If 1580, 1590 is held, say tomorrow, then this might turn out to be a good buying opportunity. Actually, a fairly similar view on the bank Nifty as well. There is an overhang of the yen carry trade even now. I mean, if you listen to some global forums or experts, I don't think a lot of them are of the view that is behind us. But if that were the concern right now, then perhaps the global markets would have also reacted. So just yet that does not seem to be a concern. It's a more domestic, local, technical factors at play, which is the expiry, for the Fin Nifty tomorrow. We've got the expiry for Bank Nifty also. Also, for the last couple of days, we've been maintaining that while markets have given that buy on dip kind of a flavor, major momentum breakout will come beyond 24,500 on the Nifty and 51,000 on the Bank Nifty. That's not happened. So we'll just wait and watch. If the lows of Monday and Tuesday are taken out, then perhaps the near-term downturn could continue and you'd want to hold your horses before you actually go out and buy this dip.
Okay. So, well, Kush is not that constructive currently. But, the other aspect to keep in mind is that if you look at the last 1 month performance, Nifty's been about 1.7%. A clutch of other markets have corrected a bit more as well. So bear that in mind. But charts don't suggest to Kush that there is an immediacy to buy into. Now, before I get in my colleague Varsha on some of the other active stocks, since Nirav Ashar is also with us, Nirav, are you buying into any of the stocks that have gotten beaten down today, or are you waiting on the sidelines?
Yeah, good afternoon, and thank you for having me on your show. Yes, we've been buying into selectively into certain counters. We've been looking at Reliance Industries, and we have also been looking at a few Adani Group counters, especially the likes of Adani Ports and SEZ, Adani Enterprises, Adani Power.
These are purely valuation calls, I would presume, or are there specific triggers for any of them? Reliance or Adani Ports or what have you?
Valuation-based calls and calls based on the cash flow generation and the profit-generating capacity of all these entities.
Okay. Fair point. Okay. Nirav, now we would want your view on some of the specific pockets as well, fundamentally. But I want to get in Varsha, my colleague, to talk about the one company which dwarfs a bunch of others when it comes to the fall today, and that is Aarti Industries. And this is on result of the con call takeaways, because Varsha had told us earlier that it's because of the miss in the EBITDA guidance, isn't it, Varsha?
Yes, Niraj. So, when people were expecting things to improve in chemical industry, here comes Aarti Industries, wherein they said in con call that they need to revisit the EBITDA guidance that they gave last quarter. Stock is down, stock is under pressure. Now, the company wants to watch margin trends over the next 2 to 3 months before committing to EBITDA guidance for the full year FY25. Now, last quarter they had given an EBITDA range of around 1400 to 1700 crores, and in FY24 they did around 980 crores of EBITDA. Now, speaking about the debt, they said that debt could reach at around 3,500 to 3,800 crore because of the Capex that they've been doing. But they do maintain volume growth of around 20 to 30%, and they are confident that they'll reach 40 to 50% of capacity utilization within the current financial year. Now, also, they expect 70 to 80% of their products to have competition from China, and Chinese competition is a major pressure on margin, particularly when it comes to agrochemical sector. Also, Red Sea issues have been impacting their freight costs. Now, just to touch upon a valuation, considering a muted growth in EBITDA of around 10,000 crores, you see the EV EBITDA multiple at around 26, which would be on the lower side as compared to other chemical companies. But do note that company expects 70 to 80% of their products to have competition from China, and by not giving proper guidance, they actually have put investors in an uncertainty. Now, speaking of the brokerages, NK has retained buy but have cut FY25 and 26 EPS by 11 and 15%, while Nuvama retains buy but raises target price, but says that some uncertainty exists on whether Aarti will meet their guidance or not, and Kotak has retained sell as they continue to find valuations on the higher side.
Okay. Well, thanks a lot for that. Nirav, Varsha, stay on. Actually, we will talk about a positive as well, but let me get in our experts' view on the same. Actually, Kush, very quickly to you first. This 15% downtake, does it open up more upsides, or is there a bottom being formed?
Afraid not, Niraj. Typically this stock has taken support at around the 625 mark, and then perhaps rebounded a couple of times. So it's prone to high volatility. So this volatility should not come as a surprise. But my concern is that it's trading below that support zone of 625, 200-day moving average being broken at a very in a very drastic manner. So I'd wait, give it another day. There's a mild recovery from those 605 odd levels, but again, nothing too convincing to say that the bottom's in place. So perhaps give it a day, perhaps a couple more days just to see if the bottom is in place. Any closing above 625, 630 would make it a near-term buy call with a favorable risk-reward ratio, but not today.
Okay, and Nirav, Aarti's commentary negative only for Aarti or other chemical stocks too. Also, are you buying into Aarti in this weakness or not quite?
No, we've not been buying into this stock because first on the valuation parameters, the stock appears quite expensive. Secondly, as far as the agrochemical cycle is concerned, there is talk that the destocking cycle is going to come to an end, but that is expected only in the second half of FY25. So I think there is definitely some pain left as far as the stock is concerned. And as a matter of fact, for the entire agrochemical sector, I think still there is some pain left to be endured. So I think we would stay away from these counters, at least for the time being.
All right. Shifting focus from chemicals to sugar. This comes as the government considers the proposal to increase ethanol prices. You're seeing sugar stocks abuzz. Let's pull up a few names. Sri Renuka is up as well in trade. You're seeing good traction in Triveni, Bajaj Hindustan, pretty much a bunch of stocks. Dalmia Bharat also buzzing in trade. Now, government considering a proposal to increase ethanol prices starting November. Varsha, help us break down the key details of this. How is this going to benefit sugar companies? You spoke with a management as well earlier today. Talk to us.
Well, yes. So if you see, government is considering proposal to increase ethanol prices starting November 24, while also pushing for diversification of feedstocks, and they aim to achieve 20% of blending target by FY 25-26. Now, a committee headed by Joint Secretary from Petroleum Ministry was held one round of discussion on the proposal, and the revision of ethanol prices will be based on fair and remunerative prices of sugarcane. Now, ethanol prices fixed by government have remained unchanged since 2022-23. And currently, ethanol production, if you see from from cane juice, is priced at around 65 per litre, while rates of ethanol from B heavy and C heavy molasses stood at 60.73 and rupees 56.28 per litre respectively. And ethanol blending in India has reached around 13.3% by July of the current season, up 12.6% during 22-23 season. Now, total ethanol production capacity stands at around 1,589 crores litres, and oil marketing companies have purchased almost 505 crores litres for ethanol for blending purposes during 23-24. Now, the sugar industry has demanded ethanol price hike as increase in the minimum selling price of sugar and permission for sugar exports. We did speak to few of managers wherein Atul Chaturvedi of Sri Renuka Sugar said that additional capacity for ethanol production already exists, and industry will be more happy to make sure that the goals of the government are met. However, the government is prioritizing ethanol production and blending targets. Sugarcane juice stand-up molasses need to be jacked up, and ban of production of ethanol, of prices of B ethanol needs to be jacked up to be closer to maize ethanol, which is at 72 rupees per litre.
Interesting. Thank you for that, Varsha. Nirav, let me come to you. Of course, industry requests or demands apart, do you believe that this is big enough when it comes to the manner in which some of these stocks have reacted? Do you believe it's large enough?
Yeah, so first coming to the ethanol part, I think ethanol is the shortest possible route for the sugar companies to make money, and there has been a regulatory ban on sugar syrup, and having said that, I think there have been a lot of investments which have been done into the ethanol infrastructure. And now with this ban, I think it's going to create problems for the industry. So the entire sugar industry is impacted on account of this ban. And most of them have built up their ethanol infrastructure based on sugar syrup. So the multi-grain feed is not available in a lot of companies. So definitely there is a pressure to hike the prices to get better remuneration so that they are able to save their balance sheets. So this is one factor. Secondly, there is a limited availability of sugarcane. So a lot of companies have been saying that while the sugar operations have been quite steady during the first quarter, the distillery operations have been impacted. So taking into account the overall picture, I would not be too optimistic about the scenario, the sugar scenario at this point of time. But I think it will be a wait and watch situation going into the next quarter.
Understood. Any names you find attractive within this space, Nirav?
So this is a very good time to have a look at companies like Balrampur Chini or Dwarikesh Sugar, Dhampur Sugar, and for that matter, even Sri Renuka Sugar. It's a time to accumulate these stocks with a medium-term horizon.
Kush, any of them looking attractive on charts, if I may ask?
None other than Balrampur Chini. I mean, that's the only one that I would have on my radar. Rest all, they've been reeling under some serious pressure. There's been selling emerging at all key levels. Balrampur Chini is the only one that's had a very clear good upside, a good run so far. This one too is hitting the resistance marks, but as I said, comparatively, a relative basis, this is the only one that stands out.
Okay, and Kush, on a separate note, we're 10 minutes from close. Top BTST ideas?
BTST or STBT, right? Or both?
Either way, yes, please.
Sure. A couple of them. First is Ipca Labs. This stock has actually again, gained strength to strength. We've discussed this in the past. Targets have been hit. By revising it upwards. From a near-term perspective, I think this stock still has steam to go to 1435, 1470 kind of levels. 1380 is where you place your stop loss. Considering the volatility, you might want to push it a little lower. Still a favorable risk-reward ratio. On the downside, on the short side, we've got Concor. We had discussed this stock as a shorting idea during the day in the FNO show with Agam. 965 was the first target, 950 was the second target. The second target almost being hit, but I think you can continue this on the short side for a target of 935, where the 200-day moving average resides. And now you can, pump down your stop loss close to about 965 levels.
Well, watch out for those ideas. It's interesting. Today we've got both a buy and a sell call on Concor. So Rajat had a buy today. Kush has a sell today. Interesting. Depending on whose conviction or whose logic you like more, you could follow that. But keep this in mind for now. Maybe Rajat's stop loss has already been hit, by the way. So that's to be kept in mind. Kush is initiating a sell call now. Rajat gave a buy call in the morning. Okay, 10 minutes left for trade. We spoke to a clutch of experts today and over the last few days on what's the larger repercussions of an outfit like Hindenburg putting out these reports. And Manish Chokhani, none other than Manish Chokhani, spoke about how Hindenburg being a short seller, trying to short sell, and that's about it. And he says there's no reason to worry about the Hindenburg hit job on SEBI. Listen.
Niraj, this is really, like I said, if your country has gone from whatever rank 50 to rank number 4, it's a sign of becoming a lot more confident about yourself. In the past, any foreigner wrote anything about us, leave alone Hindenburg. I mean, he's like just a small kind of brokerage trying to short sell. Really not relevant. Otherwise, I remember in the past, we would get so freaked out if either The Economist or the New York Times wrote a bad article about India, and everyone would be, going around like, oh my God, see how the foreigners are viewing us. They don't care. These guys, I mean, beyond the point, most, people tend to write leftist kind of stuff in the popular media. So I don't think it's like how in IPL, the advent of IPL stopped us from worrying about what the UK and the Australian commentators are writing about Indian batting and bowling, right? So it's become a bit like that it's a country which is now comfortable with itself, with the trajectory we've set on growth for ourselves. In this specific case, our regulators very, very admired, and they've done a fantastic job. So I think the market clearly just saw this as, some broker somewhere trying to write an article and profit from it. And one shouldn't put too much credence into whether it's the mainstream media or articles like this. This country is on a march of its own and it's going to arrive at its destination, whether we like it or not, whether those guys like it or not. And it's in the same vein that the rating agencies are behind the curve. That if you continue to treat India as, BBB plus when UK is running a 5% fiscal deficit and a 3% current account deficit, and they get a high rating, it's showing you that the markets have given you a sign that the Indians are going and supporting the British economy by buying, Land Rover or by, as Sunil Mittal has done today. Well, their markets are bombed out and they need support of foreign institutional inflows. And in fact, to support their country rather than us. You saw the reception Chandra got when he had to go in and, do a small project in the UK, and the Prime Minister turned up for that. It's just showing you the rising importance of India. And I think in our mind, we should forget about, all these minor criticisms that will inevitably appear in our way from people overseas. And let me just leave it at that.
Yeah, well, viewers, it was to my mind, it was a fascinating conversation. And at some point of time later in the day, I'll do a small post of some of the key things that stood out for me in this Manish Chokhani interview. You might want to tune in for that. If you might want to see that as well. Okay, what else? In today's session, punctuated by losses to some of the key high-flying stocks as well. I mean, just look at a Suzlon being in the red now. Inox Wind Energy is locked on a 10% circuit because of the arbitrage available with Inox Wind, but Inox Wind itself has come off the highs of the day. So that is the other one to watch out for. HFCL for the last few days has been doing really well, but today after knocking on the doors of 44, 45, HFCL is down about 2.5%. So a clutch of stocks have come off. Tata Motors has come off, and it's a large one. We haven't spoken about that quite as much. Maybe we should. A lot of these fertilizer stocks are down as well. Actually, Nirav, Kush to you first, and then I'll come to Nirav on Deepak Fort because he had recommended it earlier. Kush, any of these stocks which have come off today, wind energy, Tata Motors, etc., that stand out for you very quickly?
So, Niraj, this is exactly my concern that, a lot of these names are giving way towards the close, and hence, my caution towards not buying these dips. So, I still want to give it a day. Tata Motors had already seen a round of profit booking, then recovery, and, then fizzled out. I think this is the one that you should keep on your radar. Anywhere close to those, 1030 kind of zones, which have been a historical resistance level, now will act as a strong support zone. If you get it, slightly closer to those levels, or if it does hold on to those levels, then I think Tata Motors makes an interesting positional buy.
Okay, Nirav, what about Deepak Fertilizers? Or the fertilizer pack, because it's seeing some sunset today. Can there be more extended moves, or would you buy the weakness?
No, we wouldn't want to buy the weakness because we have recommended this stock at 500 levels, Deepak Fertilizers. And there's a strong story over there. The NCLT has given the approval for the demerger. We have greenfield capacities which are coming up as far as technical grade ammonium nitrate is concerned. They are working on industrial grade, stainless steel grade nitric acid. They are working on isopropyl alcohol. They have a tie-up for highly complex fertilizers with a Haifa group of Israel. So there are a lot of triggers as far as Deepak Fertilizers is concerned. And I think all these things should play out in the next 1 year. So a lot of exciting prospects from that perspective. I think we would still wait and watch. If we get some attractive levels, then we would buy it, but not definitely at these levels because we bought them at very, very low levels.
Sure, Nirav, just want to highlight another basket of stocks. A Hudco, an IRFC, an IREDA, a PFC, an REC, some of them trading at 3+ times. IRFC maybe likely even more expensive. IREDA 4.5. PFC, REC 2 times price to book. Your sense with regard to both valuations as well as what one should do at this point?
So I think as far as the power-related stocks are concerned, Power Finance Corporation and REC, I think we would still like to have a look at them because valuations are not looking that much stretched. But the rest of the pack, I think, is definitely looking quite expensive, whether it is an IRFC or an IREDA, etc. I think would go with PFC, Power Finance Corporation, and Rural Electrification.
Okay, interesting. DOMS had good results, but the stock is down 8%. By the way, all specialty chemical stocks are off today. Deepak Nitrite down 5.5%, Navin Fluorine down 5%. So that there's a prick in that balloon. So that's to be kept in mind. Keynes Tech, though, on the other hand, doing well, and Electra doing well too. Blue Star up about 6% too. Kush, you know what, we're completely out of time. Maybe we'll thank our guests and ask Kush Bora about some of these stocks tomorrow. Kush, Nirav, we'll leave it at that. Thanks so much for taking the time out. Less than 60 seconds left for the markets to shut shop. So maybe try and do that. But yeah, that's the set of stocks, the broader of the spectrum, which is doing well. On the large caps, it's looking very wobbly. So very quickly, just the heat map up on the screen because everything is looking red. Just the quantum of red, would just like to see that, whether there is enough red. Titan probably the only one standing out, a couple of defensives in pharma, but the likes of BPCL, HDFC Bank, HDFC Life, etc., all being taken to the cleaners today, Hersh.
Absolutely. Mid and small cap as well. Slightly better maybe than some of the larger caps, but 0.8% lower on the mid cap. Yes, pretty much in line with where we are on the Nifty 50 as well as, small cap has slipped quite a bit. We've closed at the low point of the day. And just quickly onto some names, if we can pull up the BSE 500 list, top gainers, losers. But while we do that, 7% up on Electra Green, some positives. There you go, Triveni Turbine, 12.5+%, Blue Star up 6+. GPPL also doing well on this day of trade. Praj 3.5%, some sugar names in play. PB Fintech on inclusion in the MSCI 3.5% higher. RT Industries lower on the back of poor commentary. You have Chambal Fertilizers, Navin Fluorine, Avanti Feeds, all lower, 5 to almost 7% down. AI engineering on the back of numbers. You also saw a Deepak Fert take it on the chin. Zydus Life, despite MSCI inclusion, down nearly 5.5%. So there you go. That's how we wrap trade for today. From Niraj, myself, everyone who puts the show together, thanks so much for watching India Market Close. Stay tuned. More action on the other side.
Hello and welcome. You're watching an NDTV Profit special. Now, India's inflation data came in last evening and inflation has dipped to a 5-year low. It's come in at 3.54% and that's compared to 5.08% that we had seen in the previous month. That's June. Now, there were several interesting takeaways from yesterday's data. One of them was the uptick we saw in core inflation. Now, according to Bloomberg, core inflation, that excludes food and fuel, the volatile components of the basket, rose 3.37%, and that was compared to 3.15% we'd seen in the previous month. This is the first time since September 2022 that we've seen a fairly significant uptick in core inflation after several months of consistent decline and the core inflation figures having touched a series low. Today I'm joined by Madan Sabnavis, Chief Economist at the Bank of Baroda, and Radhika Pandey, Associate Professor at the National Institute of Public Finance and Policy, to help us understand what are the implications of higher core inflation and how do they see this trend pan going forward. Madan and Radhika, thank you so much for taking time out for us. So, to begin with, I'll start with you, Madan. So, tell me about how you see this trend panning out, and are you looking at it as a concern at all, or is it just a healthy indicator of economic demand at this point, given that it is still below 4%?
No, actually, Pallavi, I would say it's a normal indicator because we had abnormal numbers in the range of around 3%. Historically, if you look at core inflation, that is from the time the index came through, it has actually averaged closer towards 5%. In fact, if we look at it on a monthly basis, number of months in which core inflation was above 5%, it's been higher than in case you're comparing it with food inflation. Because I think core inflation is something which comes basically from the corporate sector, let's put it that way, if I have to just separate between food and the corporate sector. So there are always a case of saying that input costs keep increasing regularly. There's a certain kind of a profit margin which has to be added. And there's, of course, the demand side influence which also comes through. So what we have seen now is the beginning of a particular spiral which we're going to come across, where core inflation is going to move towards its normal rate, which is in the region of 4 to 5% is what I believe. So nothing is going to be really surprising. We should remember that a number of corporates have already announced saying that for the last 2 years, they have not increased their prices because of the fact that overall inflation was high. So I think it's time for them to start increasing prices. At the same time, we've also seen about demand conditions also evolving, the so-called excess demand pushing up prices. We have seen it in the services sector, if you look at the recreation sector for that matter. So we have seen prices being increasing even on that score. So I think it's a fairly healthy and normal trend to see this particular number moving up. And I think we've had it a long phase where core inflation was lower, and probably we got a lot of support from it, given the fact that food inflation was very high in those months.
Right, okay. Radhika, I'll come to you now. Now, as Madan also said, this is not necessarily a point of concern because, if anything, it is an indicator of healthy demand probably. But it does still make the MPC's job going ahead a little more challenging, right? Just given that core has been providing comfort at a time when food inflation has remained elevated. And even assuming food inflation does ease in the coming months, once we see fresh produce into the markets. This is one...
Certainly, I think...
that was my question. Please go on.
Yeah, certainly. I think it's a cause for concern for MPC because if we see the data, for the last so many months, we were seeing that the core inflation was showing a declining tendency. And now we have seen that there is a reversal of trend. If we look at a more disaggregated level, in the mobile charges, inflation in the mobile charges has increased from around 1% to almost 10%. So this trend needs to be monitored. Of course, it is also an indication of improvement in demand and also a signal towards normalization of price pressures. But this is something that needs to be watched over the next couple of months because food inflation was a cause for concern, but now we have another headwind which needs to be monitored, and certainly it will, if it continues its upward trajectory, it will make the task of the Monetary Policy Committee a bit more challenging. There were these expectations that maybe in October there could be a rate cut. I think all those expectations will be tempered down by the core inflation, but we need to see whether it's a one-off event or do we see a sustained improvement or elevation in the core inflation in the coming months.
Okay, all right. Madan, coming back to you. So what is your projection, firstly, of core inflation going forward? Like, I'm just trying to understand what the magnitude of the headwind can be going forward. And also this time, like Radhika mentioned, one of the reasons we saw an uptick was telecom tariffs. That's broadly factored in now, right? We did see some other components rise as well. For instance, the miscellaneous category or personal care and effects. So are these the categories which we see rise going forward as well?
No, actually, the way it will work, we are talking of inflation, which is the percentage change in prices. So once we see the telecom prices going up in the month of, say, July, it's going to remain at that level for the remaining 8-9 months, which means that over the lower base which we had last year, we will continue to see the telecom prices being higher. So just if I draw an analogy saying that if you look at the food prices, for example, the prices of tur dal, for example, may not have gone up on a month-on-month basis. But because of the fact that we have moved from something like 140 rupees a kilo to 200 rupees a kilo, and now we are stagnant at 200 rupees a kilo, the fact that my 200 is going to be compared with a lower number in the subsequent months will make sure that pulses inflation remains high. So I think that is what we're going to see in terms of core inflation. Now, to my mind, we are going to move probably towards a region of around 4% by the end of the year. Again, I would say this would be a kind of a normal kind of a movement which we're going to see. And as far as the MPC is concerned, I think they were drawing a lot of comfort so far by saying that, look, we should be, some members took the view that we need to cut the rate because food inflation was high and therefore we have nothing, monetary policy cannot control food inflation. But today they'll have to now turn around and say that, look, okay, food inflation may be coming down, but we also have this other concept called core inflation, which is moving up, which is directly under the control of the Reserve Bank of India. So that is something which, to my mind, could probably make the Monetary Policy Committee think a little more. And I think definitely the governor has pointed out that there are no hurry to cut rates because growth is very much on target. So they can be watchful of inflation and see whether, if at all the inflation number comes down towards whichever level the RBI is looking at, whether it is going to be sustainable at that particular level before taking any different stance or looking at a rate cut.
So just to follow up on that quickly, so given by what you've said, it is fair to assume that at this point, while the RBI and the Monetary Policy Committee will take cognizance of rising core, at this stage, given the levels it is at and given the projections for going forward, it's still not something that will actively dissuade or persuade the MPC to take a call on the benchmark lending rate on the basis of that. Is that right?
No, absolutely. Because what's going to happen now is that let's assume we have good monsoon, good kharif crop, the high base effect on food products. You will have food inflation coming down. So even though we'll continue to pay high prices on vegetables, high prices on pulses, rice, wheat, but inflation per se is going to come down on the food basket side. On the other hand, when you're looking at core inflation, now core inflation doesn't have this 46% rate which we're talking about the food products. This is something which is going to keep witnessing an increase. It's not going to be as prodigious as what we saw for food inflation, but it will definitely be moving towards the 4% mark, which means that the MPC members will have to be a bit more cautious, a bit more circumspect when they're passing judgments about the future direction of inflation. Because if we look at the RBI's forecast of inflation, they're talking 4.4% Q2, 4.7% Q3. Now, this composition of this 4.7% in Q3 will be curious. Because food inflation, in my mind, will probably be moving downwards. But if core inflation starts moving towards that 4.5% range, then I think there will be an issue for the MPC in terms of deciding whether to change the stance or to even go in for a rate cut.
All right, Radhika, one last question to you before we wrap up. Broadly, given the inflation and growth dynamics, is it fair to say that growth continues to remain fairly resilient? For instance, yesterday, along with CPI inflation data, we also got figures for industrial output. And is there a concern that slightly lower industrial output would translate into lower manufacturing GVA for Q1 as well? We are expecting GDP figures for Q1 end of this month. What is the growth dynamic looking like?
So if we look at growth dynamics, purely looking at IIP, we see that there have been some signs of slackening in the IIP for the first quarter. If we look and if we saw for the month of June, IIP came in at 4.2%. And if we look at the composition, the manufacturing sector, which makes up for the bulk of IIP, it slowed down in June. And overall, also the overall IIP is showing some slackness. So if we go by IIP and also coupled with the the corporate sector results, the early bird results that we have, we see that there has been some decline in moderation in profitability of companies. So coupled together these two facts, that IIP has shown a weakness, and the major components like the manufacturing sector has shown a weakness, and from the use-based classification, it's the consumer goods sector, consumer durables and non-durables that have witnessed a decline in growth, coupled with the weakness in corporate sector profitability, which we expect that the manufacturing sector GVA could show some weakness in the first quarter. So that is just from the manufacturing sector side. There are other sectors to watch out for. But if we look at these two indicators, we can get some sense about manufacturing sector performance that, there could be some slackness owing to the lower IIP and weakness in the corporate sector profitability due to cost pressures rising.
All right. Thanks a lot, Radhika and Madan, for joining in. With that, we're completely out of time, but this was most informative. We appreciate both of you taking time out for us. Thank you for watching NDTV Profit. Stay tuned. We have more coming up.
Hello and welcome to NDTV Profit. You're watching IPO Adda, and the company we are talking to today is Interarch Building Products. It's a company which is involved in and one of the leading turnkey pre-engineered steel construction solutions provider in India. And joining me today is Mr. Arvind Nanda, who is the MD of Interarch Building Products, and Mr. Gautam Suri, who is the director of Interarch Building Products. Their IPO is opening on August 19th and closes on 21st. Price between 850 to 900 rupees. It's an IPO which consists of 200 crores of fresh issue and OFS of 400 crores, so 600 crores, giving the company nearly 1500 crores of valuation at the upper end of the price band. Gentlemen, thank you very much for joining us on NDTV Profit. To begin with, Mr. Nanda, you are raising 200 crores. Can you give us a sense of why you're raising 200 crores in fresh, and also a perspective about what your company does and the business model that you have?
Thank you for having us on the show. We are raising this 200 crores primary
we are setting up a new plant in Andhra Pradesh. So about 55 crores goes into the capital expenditure of that plant. A similar amount goes into the working capital requirements for our expected increased turnover in the coming years. And about 10 crores goes into our IT software upgrade. And 20 crores is going into upgradation and increasing capacities in our existing 3 main plants in India that we already have, and balance is a general pool. That is the current plan for the objects of the raise. Our company is primarily a pre-engineered building solution provider. So we are a company which supplies buildings as capital goods to all our clients. So our clients, when they come to us right in the beginning of their projects, they want a steel building to be given to them as an enclosure for all their machines. And today's industry, the machinery and the processes and the production is very, very complex. So the building plays a very important role. So we are no longer a simple covered shed for a client, but we are primarily the first capital goods supplier to the customer. And since we have to design, engineer, produce the whole building in parts in our own factories and then carry them to site to be assembled like a mechano set, so our role becomes very critical. So we are not simply a steel fabricator or a contractor or an EPC, but a very important capital goods supplier to the client. And that is how we have been perceived over the last 20 years by the leading names in India in all spheres of industry and by all industry. Our product is very industry agnostic, very geography agnostic, and very, very building agnostic as well. We can do any kind of building that any client of ours requires. That is the base of Interarch.
It's an interesting analogy that you took, mechano set. We all have worked with mechano sets in our childhood. Give us a sense of how the capital cycle is, or Capex cycle is picking up, because you're the first port of call for them. We're hearing about Capex cycle picking up, especially from the private sector. And since you are in the first port of call, give us a sense of how it is picking up and which are the areas or which are the sectors where you're seeing the maximum Capex coming in.
See, we are normally dealing only with the private sector. So we see we are the first port for any private sector investor setting up a plant or setting up anything, warehouse, plant, even complex buildings, etc. So we have not seen this kind of growth or this kind of demand from the private sector in all spheres of industry. There is no industrial sector which is not growing very, very fast. Last time we probably saw this was in the 2004 to 2008, that phase. Again, the demand was very huge from various sectors, especially the auto sector in those days was growing very fast. But today we see the growth coming from all different kind of sectors, whether it's warehousing, auto, all the new age sectors like renewables, batteries, solar panel manufacturing, data centers. So we see the demand, and our traditional sectors like auto and FMCG and industrials like paints and tires and is huge. We have not seen these kind of project sizes, these kind of greenfield projects, and the numbers which are coming up. It's absolutely mind-blowing what we have seen in the last 3 years, especially in the last 12 to 18 months. And I think when the economy enters into a phase of very high investment into greenfield projects, I think the whole economy is going to go for a change, because companies don't invest thousands of crores into greenfield projects if they don't see a 10 to 15 year long-term horizon of high growth. So we are seeing a tremendous opportunity, tremendous growth, and I think the government initiatives like Make in India, PLI, manufacturing, as they've been emphasizing a lot. I think every day There is some emphasis on manufacturing by the government, new manufacturing hubs, new industries coming in, trying to promote semiconductors. We are doing work with semiconductor industry also. That is going to be a growth sector. Make India a part of the supply chain, make India a part of more trade pacts so that we can participate in the worldwide growth, China plus one growth. We have not seen anything like this, in the previous 25 years of our being in pre-engineered building. It's a very exciting time to be in this business, in this country, and at present.
Mr. Nanda and Mr. Suri, it was a pleasure talking to you today. Your IPO is opening on August 19th, price between 850 to 900. It's a 600 crore IPO that puts a value of nearly 1500 crores at the upper end of the price band for you. Thank you for joining us on IPO Adda today.
The Sensex and the Nifty log worst session in over a week as banking shares drag. Indices end in the red. MSCI hikes India's weightage by 40 basis points to 19.8% as India closes the gap with China. Also lifts the freeze on Adani Group stocks, ignoring the Hindenburg hit job. After 2 straight upper circuits, Ola Electric gives buyers a chance to put money at cost 50% higher than the issue price. A stellar debut for Unicommerce e-solutions as it jumps over 130%, stock lists at a premium of more than 117% over issue price. Supreme Court accepts Baba Ramdev and Acharya Balakrishna's apology, closes contempt proceedings against the duo in the Patanjali misleading ads case. The Calcutta High Court orders the transfer of investigations in the doctor rape murder case to the CBI, notes serious lapses by the hospital administration, protests across the country intensify. As the battle for the US election heats up, Donald Trump accused of falsely claiming that there were no crowds at Kamala Harris's Detroit rally. Well, good evening and welcome. You are watching Profit 360 on NDTV Profit, and I'm Nupur Talwar Suri. Well, it's not been a great day at the markets today, so we'll first take a look at how they fared. In fact, both the Nifty and the Sensex have closed lower for the second consecutive day, and Niraj Shah is joining us with a quick look of all that went on the Lal Street.
A decline in trade, more so for the bank Nifty. You can use the term steep because that one was one that really pulled the markets along with it. So sharp cracks for the Nifty bank in particular, 1.48% down. Par for the course, by the way, such moves with the markets being at such heady levels. But yeah, I was of the opinion that there's a bias towards the upsides that got thwarted a bit today. Let's see if this continues. Bring up the heat map and show you what happened in the large cap end. HDFC Bank and ICICI Bank, from a points perspective, were the principal culprits as well. HDFC Bank in particular down about 3%. Giving it company from a percentage perspective loss. BPCL down, Shriram Finance down, HDFC Life down, Adani Enterprises too, and as well as Bajaj Finance looking a bit soft. So clutch of these financial names looked very wobbly in the session today. What did well? Titan, to an extent, some defensive bent like Apollo, Dr. Reddy's and Nestle stood out, if you will. So FMCG clearly stood out as a bit of a defensive play today. The broader end of the spectrum and the BSE 500 gainers and losers will come up on your screen, and we'll just show you what happened there as well. So some gains for a Blue Star, gains for a Hindustan Copper after the good numbers. Triveni Turbine had a big move too, and some gains for a Praj, Ajanta Pharma. Again, a bit of a defensive bent with Ajanta Pharma being right up there. But look at the losers. Aarti Industries, miss on guidance on margins, down 15%. Chambal Fertilizers, Deepak Fertilizers, that whole fertilizer and chemical pack with Naveen Fluorine also coming off. Like I said, Deepak Fertilizers coming off as well. So clutch of those names looked very, very wobbly in trade. Just want to leave you with one thought. If you can get the point contribution up on the screen, and you will see that HDFC Bank was the principal culprit. Leave HDFC Bank out, will still be in the red, will not look as bad. Now, HDFC Bank had a specific cut because of the MSCI decision. Does that reverse itself tomorrow, or does it stabilize after the fall today? Could well determine what happens to the bank Nifty tomorrow and maybe to the markets as well. Remember, global markets are not correcting as steeply as the bank Nifty has done today.
All right, Niraj, thank you very much for joining us with those details. Now, Hindenburg is just a small brokerage trying to short sell, says Inam Holdings Director Manish Chokhani. While speaking to NDTV Profit, he said that he sees no reason to worry about the Hindenburg hit job.
In the past, any foreigner wrote anything about us, leave alone Hindenburg. I mean, he's like just a small kind of brokerage trying to short sell. Really not relevant. Otherwise, I remember in the past, we would get so freaked out if either The Economist or the New York Times wrote a bad article about India, and everyone would be, going around like, oh my God, see how the foreigners are viewing us. We don't care. These guys, I mean, beyond the point, most people tend to write leftist kind of stuff in the popular media. So I don't think it's like how in IPL, the advent of IPL stopped us from worrying about what the UK and the Australian commentators are writing about Indian batting and bowling, right? So it's become a bit like that it's a country which is now comfortable with itself, with the trajectory we've set on growth for ourselves. In this specific case, our regulator is very, very admired, and they've done a fantastic job. So I think the market clearly just saw this as some broker somewhere trying to write an article and profit from it. And one shouldn't put too much credence into whether it's the mainstream media or articles like this.
Now you can listen into that entire interaction with Manish Chokhani at 5 this evening. Investors know that the Indian markets, how they are, and they will invest on the basis of data and not a baseless report. That's what Mohan Das Pai, the chairman of Aaron Capital, has said. Listen in.
Investors globally know what is India. They've been following India for 25, 30 years. They have put in $800 billion of valuation. They put in $600 billion of private equity and venture. So they know what is India. They've got deep roots in India. They understand everything. They will also invest in every Adani company. Adani can easily raise capital. So all this frivolous argument by the thinking by people like Hindenburg and George Soros, it will destroy confidence, are all frivolous. I mean, shows the weakness of the mind and the weakness of the thinking. Because investors, foreign investors, when they come, they meet people, they look at data, they look at analyst report and invest. They don't go by people like Hindenburg. Hindenburg is not a credible person globally. He's a vulture fund, he's a short seller. They create fake narratives.
And a quick programming reminder for this interview as well. You can catch it at 6 p.m. this evening. Now, the MSCI has added 7 Indian stocks to its global gauge for emerging markets under its August review and removed one. According to a statement, the changes will come into effect from the 30th of August before the markets close. With the latest review, India's weightage in the MSCI standard index will increase to 19.8%, whereas China will see a dip of 50 basis points to 24.2%. Hersh is joining in with more details on this. Hersh, take us through what this means. And it does, of course, appear that India is closing in on China.
Well, it was that time of the month, or the semi-annual rejig for the MSCI came out earlier today morning. We saw several changes. First off, India's weightage increased by 40 bips, 0.4%, now stands at 19.8%. At whose expense? Well, it was China which gave way. 50 bips lower in terms of China's weightage, 0.5% lower to 24.2%. So that was the larger countrywide theme. Let's talk about some specific names. We had, first off, the biggest mover in trade, or rather the biggest market mover in terms of market cap in trade was HDFC Bank, 3.5% lower on the back of the fact that the rejig in weights was lower than expected. We're going to further anticipate a rejig to happen later in the year. So therefore, another $2.2 billion worth of flows likely deferred, expected before the 30th of August, but now will be deferred to the 30th of November. So you'll have to wait maybe 3-4 months. The stock, of course, taking a bit of a beating along with the larger markets in trade today. So that was one. Second, you had Adani Enterprises as well as the entire Adani Group stocks also in terms of their embargo by the MSCI being lifted. They'll now be considered for the purpose of MSCI inclusions. So we'll have to keep our eye out on that. But let's talk about certain meaningful additions. RVNL, Zydus Life, Vodafone Idea, Oil India, Oracle Financial, as well as Dixon Tech, along with Prestige Estates, were a clutch of stocks in focus on the back of additions made to the emerging markets index. One deletion made as well. Bandhan Bank being removed. No weight hike largely for HDFC Bank. That was also another negative. Let's also pull up the Indian Domestic Standard Index and additions therein. Again, a lot of the same names, but along with it, you'll see Bosch, Phoenix Mills, Dixon Tech, and PB Fintech. Those 4 new names, along with the likes of an RVNL, Zydus Life, Vodafone, and Oil India, are also included as part of the standard index. Let's also switch focus towards the small cap index, because some movements there, 27 additions and 6 deletions. The major ones in terms of additions, you saw Bandhan bank which switched from the mid cap to the small cap. Go Digit was also one significant addition. Dixon Tech, though, was upgraded from small to mid, and that was a big move. Irida, Cochin Shipyard, Hudco removed from the small cap index, and India's weight in the small cap index dipped around 20 basis points to 28.8% now. Now, in terms of certain domestic small cap index changes, 25 additions and 8 deletions there. Go Digit again being the top addition. RVNL, Phoenix Mills, Dixon Tech removed due to upgradations that have been made, and Irida and Cochin Shipyard also removed altogether. No additions made there.
All right, now Sanjeev Hota, the VP and head of research at Sharekhan, has lauded the MSCI's decision to remove the restrictions concerning the Adani Group shares. He refuted the claims made by Hindenburg on their second report. Listen in.
Definitely, MSCI must have decided this thing to be done. They have not waited for another Hindenburg report to come. So I don't really see this is a correlation between Hindenburg's second report and what MSCI has done. But what I read is that it is a very welcome kind of move, because you cannot depend on any foreign agency writing a report on something and MSCI taking a stand on that. So I don't really see that playing out well.
Now, after 2 straight upper circuits, Ola Electric has given the buyers a chance to put money at cost 50% higher than the issue price. The firm paired all gains today to end more than 1% lower. The upper circuit surge had come in just a day ahead of Ola Electric's first quarter results. The company is also gearing up to unveil its first electric motorcycle on Independence Day. And in fact, the street saw 2 listings today. Unicommerce Solutions made a stellar debut at a premium of more than 117% on its issue price. And Brainbees Solutions, the parent company of First Cry, debuting at a premium of 40%. Anand Mahindra was present at Brainbees' listing ceremony. Both the listings were better than expected. Listen in to the managements of both companies speaking about their growth outlook for FY25.
Zoom out a little bit. What is Unicommerce? Unicommerce is essentially an index to the e-commerce market. Whereas e-commerce volumes grow in India, we anticipate our business will also grow. Historically, we've grown faster than the e-commerce market, and the goal would be to continue to do that in the future. For instance, last year, the e-commerce shipments in India probably grew at 8 to 10%. We grew our revenues at 15% plus. And the goal would be that as e-commerce grows at a 25% CAGR on an ongoing basis over the next few years in the medium term, we should continue to beat that e-commerce shipment growth. And the reason why I mentioned we are an index to the e-commerce.
India produces 24 million babies a year, right? So volume growth is imminent.
Yeah.
It can't be without volume growth. So be rest assured that we will continue to demonstrate both volume and value growth over a longer period of time, as India is the world's capital for mothers, baby and kids. And not just in India, both in UAE and Saudi Arabia, where we are the largest online specialist platform in those countries, we'll continue to compound there as well. So we'll make India proud. We'll make millions of families in India and abroad have this feeling of joy in their entire parenting journey being with us.
In fact, sugar stocks were buzzing today after the government considered a proposal to increase ethanol prices from November. Varsha Chandani is joining us with the details. Varsha, take us through what this could now perhaps mean.
Government is considering proposal to increase ethanol prices starting November 2024, while also pushing for diversification of feedstocks, and they aim to achieve 20% blending target by FY25-26. Now, a committee headed by Joint Secretary from Petroleum Ministry has held one round of discussion on the proposal, and the revision of ethanol prices will be based on the fair and remunerative prices of sugarcane. Now, last week, Corporation Minister Shah called for a multi-dimensional approach to biofuel manufacturing and affirmed that India would achieve its 20% ethanol blending target by FY 25-26 ahead of the original 2030 deadline. Ethanol prices fixed by government have remained unchanged since 2022-23, and currently ethanol produced from cane juice is priced around 65 per litre, while rates for ethanol from B heavy and C heavy molasses stood at around 60.73 and 56.28 per litre respectively. Now, ethanol blending in India has reached 13.3% by July of the current season, up from 12.6% during 2022-2023 season. Now, total ethanol production, if you see, the production capacity stands at around 1,589 crores litres, and oil marketing companies have purchased almost 500 crores litres for ethanol for blending purposes during 2023 and 24 season. The sugar industry has demanded ethanol price hike as an increase in the minimum selling price of sugar and permission for sugar exports.
All right, Varsha, thank you for that. And on that note, it's time for a short break. On the other side, we'll bring you detailed coverage on the Kolkata doctor's rape murder case. The CBI is taking over.